Hi, this is Marty. This is my very first video, so please bear with me. I saw this chart pattern and it was so beautiful and perfect and such a great example that I thought I'd make my first video and go over how I'm going to handle this. So this is a stock, AMPY. I have no idea what the company does. The one thing I'm not happy about with this chart is the volume. I guess it's averaging a little less than 250 shares per day. I would have liked it to have been higher, but it's just barely sufficient. But the pattern that I see is cup and handle. So, see, cup and handle. So this is the cup, and this is the handle, right? And then this is a trend line connecting this side of the cup and this side of the cup, and it goes through. So there's a lot on this chart. Don't try to look at everything at once. I'm just going to go through it kind of layer by layer and just try to picture those layers. So right now, just picture this formation. It's a cup and handle, right? And it broke through that trend line and then turned around and came back, and right now it's retesting that trend line. And I expect it's going to break to the upside. Now, when a cup and handle breaks out, there's a way to project how far the price will move. So what you do is you see this thick white vertical line. So you drop that from the trend line that connects the top of the cup. You drop that down to the bottom of the cup. And then you make a copy of that line and you move it to where the breakout occurs. So here's that copy of it, this white line right here, okay? So you see the bottom of the white line is right on the trend line, right at the breakout point, and it projects that the price move will go all the way up to here. However, in my experience, very often, most patterns, the measured move stops at half the measured move. Sometimes it goes the whole way, but very often it'll stop at half. So I'm going to set 50% of the distance of this line as one of my price targets, one of my price objectives. So at the 50% of the length of this line, turns out to be 828. Okay, so I'm going to put one of my price targets at just under that. See over here it says sell limit 827. So 1 penny under, that's going to be one of my price targets. So that's based on the cup and handle formation. So another thing, another pattern is called an ABCD pattern, where you have, see the yellow line, this thick yellow line. Okay, so we're going to look at that now. So you go from a swing low to a swing high. This is called a swing low, and this is called a swing high. So you draw your line, and this is point A, this is point B, and then you have a retracement, and this down here would be the bottom of your retracement or another swing low. That's point C, and then you copy this line and situate it beginning at the bottom of your retracement. Okay, so this would be point C, and the top of that is point D. So the expected projection of this price move would be up here at point D. So this is another possible profit level that I set. So this D, as in delta, D point, ends at about $8.67, and I set my profit target just under that, $8.65. Okay, so this is an AB equals CD pattern. Now another layer on top of this is what are called Fibonacci levels. So I won't go into a whole discussion of Fibonacci, but what you do is you want to see how much of a retracement this is, for one thing. So you see the green line, see it says 0%. So you start your Fibonacci range at this swing high, and you bring it down to the swing low. So the bottom's $4.91, and that's the the bottom of my Fibonacci range. So it goes from 0% down to 100%. That's my range. Okay, and we can look at this retracement, and we can see it just about touches the 38.2% Fibonacci retracement level. Well, and then swings back up and starts to break out, goes higher than this high. It's on its way breaking out. If it only retraced to 38.2, that is a very strong, this is a very strong uptrend to only retrace down to the 38.2 level. Retracing to the 50% level would be much more common, and it's not uncommon, and a lot of people expect a retracement down to a 61.8% level. And the fact that it only made it down to 38.2 and then went up and broke out tells you this is a very strong uptrend. So you can expect you're gonna get a good move out of this. Now, two common targets based on the Fibonacci extension after a breakout is the 27.2% extension and the 61.8% extension. So this is a 68% retracement. This is a 61.8% projection. And it just happens to beautifully coincide with the AB equals CD endpoint, right? There's point D, and it's also the 61.8% Fibonacci extension. So this is a fantastic target, and it's probably a likely target. But another more conservative target for a Fibonacci extension is the 27.2% level. So just in case we only make it this far and then it turns around, and that's not uncommon, that happens to me all the time, I want to set my first target at this level. So the 27.2% Fibonacci extension is $7.87, and so I set it at 1 penny under that. So you sell limit 7.86. So I have three different price targets, so I set up three different orders. Now, right now, you see this thin white line? This is a downtrend, and you see how the bottom of these candles all hit at the same point? The bottom of this candle, bottom of this candle, bottom of this candle are all right at about $6.80. It lines up just beautifully. And then you have the tops, each top's a little bit lower, a little bit lower, a little bit lower. So this is creating a triangle or a wedge, and it's either going to break out to the downside, which we don't want, that would be breaking the pattern, or it's going to break out to the upside, which is what I expect. So I don't know when it's going to break out, or if it's going to break out to the upside. It could break to the downside, or there could be news or a tweet or whatever that's going to drive the market down, and things won't work out. So I don't want to just buy it. By the way, it's about 10 o'clock in the evening Eastern time. So the market's not open, so these aren't moving. Excuse me. And I don't want to put a order in to just buy at the open, because it could just pop up a little bit and then drop. So what I did is, rather than just put a buy at the open of the market, is I put what's called a buy stop limit. So a stop limit has two parts to it. It has the stop level, which is where you're going to trigger the order. So I set my stop at $7.26, which let me expand this out a little bit. You can see it better. Expand this out. Right, so here's just my buy limit at 726. So right now the candle ended yesterday, or today, the candle ended at a 714 level, 713 level. So I'm not going to buy it unless it comes up to this point here, the 726, right? 726. So what I said is to not buy it here or here or here. I want it to come up. Now, I'm going to lose a few cents worth of value between here and there, but it's worth it to me to have confirmation that this is breaking out to the upside. So I set my level just a little bit above this candle high and this candle high, and it's a little more than halfway between here. It's just a loose positioning, right? And it's also above this high, so it feels confident. It's an art, this part, right, where you put your buy stop limit, but I set it here. So by the time price hits here, it's definitely breaking out to the upside. Now, another thing that could happen is when the market reopens tomorrow, there could be a gap up. That is, it won't open here, it could open here. Well, it could open anywhere. So if it opens too high, I've already lost so much profitability, I don't even want to be in it. Plus, if it opens pretty high, there's a good chance it's just going to drop from there to fill in that gap. So if it opens up too high, I don't want to be in this trade. So what I did is I set a limit. Right, so it's not just a stop. So a stop says the stop is the 726 to buy, but the limit part of it is 10 cents higher, 736. It doesn't show on the chart. But what I said was in my order, if when price hits $7.26 or higher, I want to be in it. But if price is higher than $7.36, I don't want to be in it. So price has to be between 726 and 736 for my buy order to trigger. Okay, and I set up, oh, well, let's talk about risk. So I also have a stop, right? This is my stop, $6.75, which is a little under the bottom of this wedge, right? Here's the line, here's the bottom of the wedge, and I put my stop down here, this red line, 675. So what is my risk? Well, if I enter, let's say, worst case, 726 to 736, somewhere in there. So let's say that's what I pay per share, and my stop is 675. Well, that's about a 50 cents, roughly 52 to 60 cents difference. So that would be my risk. So if my order's filled and it turns around and comes right back down and hits my stop, I will lose 50 cents a share. So I'm going to buy 3 different lots because I have 3 different targets of 100 shares each. So my maximum loss would be 50 cents times 100 shares is $50, and I got 3 lots, that's $150. So my max loss theoretically is $150. But when this goes and it hits my targets, they're going to be more than 50 cents each. And so there's a risk to reward ratio. So I won't go into that anymore right now, but I can tell you that if it hits my targets, the reward is significantly greater than my risk. Okay, so I'm going to set 3 orders. They're all going to have the stop limit to buy at 726 and less than 736. They're all going to have the stop at 675. But those 3 orders are going to have 3 different targets. The first target is the 786 at the 27.2% Fibonacci extension. The second lot's going to have a target of 827, which is at the 50% move up the measured move of the cup and handle. And the third lot's going to have a target of 865, which is the D point of the AB equals CD, as well as the Fibonacci 61.8% extension. So let's see, is there anything else? I can't think of anything else to mention right now, but that's the setup, and it's such a beautiful chart. Everything sets up so nice and perfect that I was inspired to make my first video. I hope that was clear and perhaps educational. Oh, so there is one last thing. So this is a stock, not say a commodity or bonds or something. So when there's a stock, you have to think about the earnings report. It comes out quarterly. Every stock has a different reporting date, and they report their quarterly earnings. Well, my policy is to never hold through an earnings report because it's a 50-50 chance, in my opinion. It's a crapshoot. You never know how it's going to break, and sometimes it breaks really hard, the stock price. So I don't want to be in the market. I want to be out of the market for the earnings report. So there's a website called earningswhispers.com. So I looked up AMPY on Earnings Whispers, and it said that the next quarterly earnings report is on February 5th before the market opens. So I will be out of this trade by the close of the market on February 4th, because I do not want to be in the market when that earnings report hits, that morning before the market opens. Okay, so that's the last thing. So thank you very much, and Hope this turns out well. Talk to you later. Bye.